Canadian banks keep saying that interest rates are either going to stay flat or go up, but Canadian inflation just came back in at 2.3%, which is below expectations. And if you're floating a variable rate mortgage or renewing or purchasing in 2026 or beyond, that number matters more than headlines and what the headlines are telling you. Because while the big banks are still publicly projecting rates staying higher for longer, the actual data is starting to lean the other way. Today, I'm going to show you what the inflation numbers actually say, why money supply matters more than most people realize, what the bond market is signaling, and what this means for you and your mortgage over the next 12 months. Headline CPI came in at 2.3% in January, which is down from 2.4%. That alone doesn't scream rate cuts, but here's where things get a little bit more interesting. Core inflation, the number that the Bank of Canada actually watches, also cooled. The CPI median fell from 2.6 down to 2.5, and the CPI trim dropped from 2.7 down to 2.4. And more importantly, month over month, core readings were absolutely muted, nothing resembling the accelerations that we saw in 2021 and 2022. The question is, why does this matter, though? And it matters because central banks don't cut based on vibes. They cut rates when inflation momentum fades. And right now, momentum is fading. Now, here's something that almost nobody on financial YouTube explains properly. Inflation follows money growth, not feelings, not politics, but money. In 2020 and 2021, money supply in Canada exploded. We're talking double-digit growth here. And what happened 12 to 18 months later? Well, inflation, as we saw, it ripped up to 8%. And that wasn't random. It was mechanical and mathematical. Now, money supply growth is sitting near zero, which is well below historical averages. And historically, when money growth stalls, inflation doesn't suddenly reaccelerate. It cools. If inflation was about to spike again, you would see leading indicators in liquidity. They're not there, and that's what matters. Another thing that was looked at was unemployment coming in at 6.5%. Now, on the surface, that's not catastrophic, but here's the nuance behind it. Canada lost 25,000 jobs. The unemployment rate only held steady because roughly 100,000 people exited the labor force. That's not a booming economy, that's softening demand. And here's the historical reality. The only time Canada sustained high inflation alongside rising unemployment was during the 1970s stagflation. That period had massive oil shocks and rapid money printing. We don't currently have either at scale. So inflation plus weakening labor markets plus stagnant money growth, that doesn't point towards hikes. It points towards rate relief, eventually. Now, this is where it gets practical for you. The 5-year Government of Canada bond yield has dropped roughly 20 basis points over the last month. Bond markets move before mortgage lenders do. And these bond markets really dictate what happens with our fixed mortgage rates here in Canada. And they're pricing in slower growth, cooling inflation, and potential policy easing. This is not theoretical. This is mechanical and mathematical and what's behind these fixed rates. When bond yields slide consistently, fixed rates eventually follow and go down as well. Now, let's talk about something uniquely Canadian. Over 1 million mortgages are renewing into rates that are 2 to 3% higher than what the borrower's locked in at. We've talked about this quite a few times on this channel. That's thousands of dollars per month per household. Where does that money go? Well, it goes out of consumption, out of the economy. It goes specifically into servicing a debt. That is deflationary pressure. Combine that with falling home prices, which is limiting borrower capacity. Debt to income ratio is still historically elevated, and consumers tightening on their budgets. And you don't have the ingredients for an inflation breakout. You have the ingredients for an economic slowdown. And when growth slows, generally speaking, central banks start to cut. Now, here's where it gets a bit uncomfortable. The big banks are still forecasting rates staying flat or even rising through 2026 and beyond. Why? Because forecasting conservatively protects their balance sheets. It doesn't necessarily reflect what the bond market is pricing. Big institutions manage risk publicly. Bond markets price risk silently. Right now, the bond market is not screaming rate hikes. If anything, it's leaning the opposite direction. So what does this mean for you? Well, if you're in a variable, it doesn't mean celebrate immediately, but it does mean that you can maybe slow down on panicking about rate hikes in 2026. They could still happen, but they may not happen, and the data is showing that it's more likely that they won't. For fixed rates, well, you're locked in. But if you're looking at buying a house and getting a fixed mortgage, you're going to want to watch the bond yields, not the headlines. If yields continue drifting downwards, fixed pricing improves. If you're renewing in the next 6 months, well, you're going to want to watch all of this. Don't try and time the market, but try to understand it. The probability distribution is shifting. The risk of aggressive hikes is lower than it was 12 months ago, and the room for measured cuts is increasing unless we get some form of major external shock. Right now, the data shows inflation cooling, core measures stabilizing, money supply stagnant, labor market softening, and bond yields falling. That combination does not support a renewed tightening cycle. Could something change? Of course. But if you strip away the noise and look at the data, the direction isn't pointing for up, it's pointing for down. And if you're making a mortgage decision in 2026, you need to understand this data, not just the headlines. Now, if this breakdown helped you think more clearly about mortgage strategies and what's going on, maybe think about hitting that subscribe button or liking this video so more people like you can see it. And if you want someone to help you with your mortgage who's keeping tabs on all this stuff so you don't have to, there's a link in the description where you can book a time to chat with me or my team, and we'd be more than happy to help you out any way we can. Because honestly, clarity is the real advantage in this market, and that's what our goal is to provide. My name's Myles Nowik of the Nowik Mortgage Team, powered by Andy Mortgage. Thanks so much for watching. We'll catch you on the next one.